Interpreting financial statements is crucial for understanding a company's financial health and making informed investment decisions. In this video, we are sharing 8 steps to help you interpret financial statements effectively. 1. Understand the 3 main financial statements. Financial statements comprise of the balance sheet, income statement, also known as profit and loss statement, and cash flow statement. The balance sheet outlines assets, liabilities, and stakeholders' equity at a specific point in time. The income statement shows revenue, expenses, gains, and losses over a given period of time. Lastly, the cash flow statement details the inflows and outflows of cash during the specified time frame. 2. Analyze profitability ratios. Profitability ratios reveal how effectively a company generates profits relative to its revenue or assets. Common ratios include gross margin, gross profit over revenue, net profit margin, net income over revenue, return on assets, net income over total assets, and return on equity. Higher values indicate better profitability performance. 3. Assess liquidity ratios. Liquidity ratios assess whether a company has sufficient short-term assets to cover its immediate obligations. Key metrics include current ratio, current assets over current liabilities, which measures overall liquidity, quick ratio or acid test ratio, current assets, inventories over current liabilities, which evaluates immediate solvency without considering slow-moving inventory, and cash ratio, cash over current liabilities, indicating ability to meet obligations using only available cash resources. 4. Examine leverage or debt ratios. Debt ratios provide insights into a company's borrowing capacity as well as risk exposure due to excessive debt levels. Important indicators include debt-to-equity ratio, total debt over shareholders' equity, interest coverage ratio, EBIT over interest expense, measuring the ability to service interest payments from operating earnings, and debt-to-asset ratio, total liabilities over total assets. 5. Analyze efficiency or turnover metrics. Efficiency metrics determine how well a company utilizes its resources, such as inventory turnover, revenue over inventory, accounts receivable turnover, revenue over accounts receivable, and asset turnover, revenue over total assets. Higher values indicate effective use of resources. 6. Compare financial statements over multiple periods. Analyzing trends by comparing financial statements across different periods allows you to identify patterns or changes in a company's performance. Look for improvements or deteriorations in key ratios, revenue growth rates, profit margins, and cash flow generation. 7. Consider industry benchmarks. Comparing a company's financial ratios to industry averages provides context and helps evaluate its competitive position. This analysis can highlight whether the firm is underperforming or outperforming relative to peers. And 8. Dig deeper into footnotes and disclosures. Financial statements often include accompanying footnotes that offer additional explanations about accounting policies, contingent liabilities, related party transactions, and other crucial details. Review these notes thoroughly as they provide important insights into potential risks or issues. Remember that interpreting financial statements requires both quantitative analysis using various ratios as well as qualitative evaluation considering broader economic factors affecting the business environment. Developing a strong understanding of finance principles alongside regular practice will enhance your ability to interpret financial statements effectively. If you found this video helpful, then like, share, and subscribe to this channel to get future videos.